Of Selfwealth Live, the technical analysis edition or traders edition. Jace, how are you this week? How's everything going?
I'm good, Rog. Good to be back on the program and talk about some charts. So it should be interesting as always, hopefully.
It will be. I'm pumped. I always love hearing. This is one of my favorite topics, to be honest, because I think at the end of the day, if I was speaking to someone in the office the other day and we were talking about how technical analysis is kind of a self-fulfilling prophecy, right? Where there's points on the chart that everyone's looking at, and that's kind of like what helps drive trading decisions when it comes to technical analysis, right? So this week we're going to be diving into the markets in general, obviously where they're at, and then we're going to be talking about pinpointing these resistance, as we've coined it, like a pro, resistance and support levels, or supply and demand, whatever you want to call it. All right, and we'll talk about why they form. And it should be good. A bit of a recap of some of the things we talked about last year as well. But it's always good to talk about things and reconfirm information in our minds, just so we become really, really good at what we're looking at, right? So, Well, how is your? Just before we get on here, Jace, I want to know how is your? I might be putting you on the spot here, sorry, but how has your portfolio performed over this year so far, 2024?
It's been pretty good. It's been pretty good. Like 2022 was pretty miserable, I think, for most people. So when you get the downward part of the market, it becomes a defensive game. It's about protecting capital, and two types of capital. There's financial capital and there's also your mental capital. It's not about trying to not get beaten up too badly, so that when the markets come out the other side, you're still there. You got capital and you haven't been mentally fried through the experience and you're ready to go again. So it can still be a bit discouraging, but it's one of the things we've got to learn to deal with in the market. So 22 was a year of drawdown, and then last year was a year of the comeback. So surely but slowly the signals started to emerge for emerging upward trends. And it's been a case of jumping on those, and some of them have been going really well. So I was looking at my portfolio. I was showing members of my weekly strategy session a few weeks ago, 2-3 weeks ago. I think we actually did it here as well, didn't we? We had a look on Selfwealth Live, and I think there were like 6 stocks which were up over 100%. So that's it's a good sign. It's a good sign when you're starting to see trends appear and then evolve into big double digits and even triple digit territory. So that's not to say every stock does that, but we're in that environment which is conducive to getting some of those nice extended trends. And then it's a case of letting those profits run to maximize, because this is a really important point. When you get on a stock which is doing well, you want to maximize your gains from it, because they don't all do really well. And do the best you can from those big performers, and then you're going to get the ones which just muddle along or you get a loss from. That's okay. They're part of the process. I've got those in my portfolio too. But minimizing those ones which aren't doing much and letting those good ones run.
Okay, fair enough. That's good. Good morning, Scott, and welcome everyone else here. I should remind everyone that we need to show a disclaimer, of course, because we're just talking about, we're talking about stocks all the time, right? So obviously, up to you guys to do your own research. But Jace, can you please show us a lovely disclaimer?
Yes, everything we talk about today is, of course, general commentary only. No personal advice given. And this disclaimer will just outline all that. So the top portion is about me. So I'm not part of Selfwealth. Motion Trader is my business, and you can see Motion Trader's licensing details there. And then we've got the Selfwealth disclaimer, which will have Selfwealth's information and licensing and so on. So again, it's all general commentary only.
Thanks, Jason. And g'day, Dean. G'day, Mike. G'day, Rodney. Thanks for everyone for continuing to come. Much appreciated. Don't forget to put your questions or any stocks you want to put in. Try and put them in as early as possible as well, so we don't get to the end of the show and I'm pushing Jace out for more time of his as well. Obviously, we appreciate his time, but let's get any stock tips in as soon as you can. and that would be great, and we'll have a look at those. But before we do that, don't forget to like and subscribe as well. And then, Jace, let's have a look at the markets in general this week. How is the ASX looking? Looks to be sort of still just struggling a little bit.
Yeah. Okay. Well, let's jump into these charts. So, first one, let's start with the ASX 200, and we had a few relatively quiet weeks recently, and we're just starting to see a bit of volatility picking up just last week. Really, we had volatility came up a bit, and it's interesting because it's coming right at this big overhead resistance area. We're going to talk a bit more about resistance and supports later on. But you can see this big overhead resistance area where I've got that blue shaded horizontal bar, and it takes in the highs from 2021, 2022. Just recently in December, the market was up here before pulling back, and now here we are again, and the volatility is picking up. And one of the things we've been talking about, Rog, over the last maybe the last 2 or 3 weeks now, has been talking about the possibility of some sort of a pullback that could last a few weeks. And my feeling has been, and it still is, that we've had a big run. The market has had this big run off the October low, and it would be quite normal after such a situation to get a bit of backing and filling, where you see prices consolidate. So they pull back and they chop around, and I still think that's a strong possibility. Looking at where the ASX 200 is at the moment, it's not overly stretched above the moving averages. So I've got the 50-day and the 100-day moving average. But look, it is a little bit elevated. So some sort of a retest of those averages would be quite a normal thing to see. And also, just looking at like how the price actions played out over the last week, we actually did get that sharp fall last week, which came back to the 50-day moving average, and we've got that nice rebound off it. But is a one-day retest of the average enough to say, okay, we've now consolidated all those gains from October? Like, I don't think so. I've kind of been looking for more of a multi-week consolidation, not just a one-day pullback. But look, having said that, we've got to look at the price action as it is, and at the moment that price action is still edging higher, and so there's also clear interest on these pullbacks. So we had the pullback in January, the pullback last week, and both of those saw the buying interest, and the buy the dip came in, and I think from that perspective, I think it's constructive. So the strategy we've been talking about, and I've been talking about, for like managing this situation, it's about staying with stocks which are in uptrend. So those stocks I told you about in my portfolio, which are up like 100% or more, I'm not selling them. I'm not taking profits. I'm not selling down. I'm not selling half. I'm continuing to hold, because that's why I've made money in these stocks, because I've held them. So that remains a strategy. It's staying with stocks which are in uptrend, and then using a wide trailing stop. So that's what I do. That's my approach, using those wide trailing stops. It gives stocks room to move around, or gives the ASX 200 room to chop about, but trying to stay in those positions. Because I think a mistake a lot of people make is they see a bit of volatility come in, and they start to get a bit nervous, and they say, "Oh, look, I'll take profits. This market's picking up a bit of volatility. I'll just sell now. I'll take some profits." But we've got to remember that you make your money by staying with your good stocks, not by selling them, and or not by selling them too early. I think that's a problem a lot of people have, in they get out of their good stocks too early. And also, one thing which is really, really prominent in my mind is I'm looking at this chart, compressing a little bit, taking the whole thing in. We've got the rally during 2020, 2021, this big sideways period. Big sideways periods, when they end, they typically lead to big moves in whatever the direction of the breakout is. So this one hasn't definitively broken to the top side yet, but it looks like it's on the cusp of it. It looks like a break to the top side is close. So even if it takes several more weeks or several more months of pulling back and consolidating, I want to have exposure to this market, because should this break to the upside, I want to be on it. I don't want to be sitting on the sidelines. So that's why I say I'm holding stocks, using those wide trailing stops to try and stay in them and maintain exposure to this market.
Yeah, fair enough. And my question to you, Jason, is do you think it's like the other fundamental traders, and I know once again you're not a fundamentalist, but is it the fundamentalists that are looking at these levels as well and stopping themselves from, obviously it's the big institutions that are pushing these prices in around. It's generally not us smaller retail traders. Is it these guys that are just holding off now just because they see these all-time highs, or why does the market rally so much to get to these levels and then just stops? Why do you think that is, in your experience?
Yeah, look, there are a lot of people who probably are not looking at charts at all. There'll be big institutional players who do pay attention to charts and levels. And that chart can be used in many ways. Some people are looking for patterns. Some people are just looking for where the previous peaks were. Some people are doing all sorts of analysis, like they could be looking at Elliott wave or Garn, which is more very esoteric in its application, which is what I'm not doing. So very different ways to use a chart. How these levels form? Well, it's an all-time high is a number. So the market got to, where did we get to? We got to 7,600. So that becomes an anchor point in people's minds. Okay, the market reached an all-time high of 7,600 in August 2021. So you get situations where people who bought around that all-time high, they then saw the market pull back and they're losing money. And then they might say, well, I'm not happy with this, but I'm going to hold on and I'll sell. I'll sell at the market if my position gets back to even. We hear that sort of thinking a lot in individual stocks. So the market makes its way back up to 7,600, and someone who had bought, it could even work on at some sort of institutional level as well. 7,600 becomes an anchor point, and it's like, okay, the market stopped there last time, so I'm going to lighten my position at 7,600 thereabouts. So that's how a resistance point can form, because it brings in supply, and then the market falls away again, and then it comes back in April 2022. So the third time. So now we've seen it 7,600. We've seen it stall there a couple of times. It's a point where supply can come on. Someone might think, okay, the last couple of times it's been up here, it's stalled. So this is a point to bring supply onto the market. And as history will show, this time it held again, the market came off, and so on. That's how a resistance point can form, because it's a point which is attracting supply for whatever that reason may be. And the opposite applies with support. It's an area where the market has found support in the past. But I'm probably straying a little bit from where we were going to be continuing to talk about the markets. But just a little bit of probably jumped ahead a bit of where we need to be at the moment.
I wanted to ask the question just purely based on the fact that when you do technical analysis, it's funny because you can pinpoint these levels all the time, right? But the fundamental guys are out there. They must have some inkling of all these things as well. Otherwise, why would you have such a large rally and then it just all stalls right at that number, right? So, but we'll talk more about that. In the show, right? For now, let's have a look at the US markets. Yes.
Yeah. Okay. So S&P 500. Really, nothing more can be said than this has been one of the most extraordinary runs. Like looking at that low in late October to where things are now, it's a really big rally. And just putting into some sort of context, it's so from that low in October to the recent high, the S&P was up 14 weeks out of 15. And the last time that happened, as far as I understand it, you've got to go back to 1972 to get another period where you find 14 up weeks out of 15. So it says it all just by just in that alone about like how strong this period has been. And of course, that brings up the whenever I hear something like that, I want to know, well, what happened last time this occurred? So what happened in 1972? What happened after those 14 up weeks out of 15? And well, what happened was the market went sideways for several months, and then it had another rally up to new highs, and then it had a big fall. And but look, that's just what happened then. Every period is different, so I don't think we should use that as a template for what's going to have happened now. It's just a point of interest that it's what it did that time. Because one of the things I often see people do, I've seen people doing this since I got into the markets in the 90s. They like doing comparison charts. They'll pull up another period. So, for example, what happened in 1972, and then they'll overlay it with the current price action and go, okay, there's your roadmap for the next, what the market's going to do next. And I saw it a lot during this decline in 2022. People were calling up charts of the decline from the GFC in 2008, and there was a decent resemblance during a good portion of that fall. And they said, "Oh, look, it's all matching up." So when the market might have been somewhere around October 22, they said, well, the next point based on our roadmap from 2028 is this cataclysmic decline. And of course, that didn't happen. So this is why I say every period is different. Don't go back to 72 and think, okay, that's your roadmap. Doesn't work like that. It's just an interesting little historical footnote to show that market hasn't done this for a long time. It has been a really strong period. So putting that aside, it's where does this leave us now? And volatility, just like in the ASX 200, just started to creep in the last week. All-time high for the S&P 500 Monday last week. The Tuesday after that, a 2% decline, been clawing its way back over the last week. But just looking at this chart, it's like, I look where these moving averages are, the 50-day and the 100-day, and the S&P is getting a bit stretched. It has been a bit stretched for the last few weeks above the averages. So that always opens the window to some sort of a retest of the averages. And one of the things I like to say about moving averages, in that when a market's above the averages tend to be a bit like, have their own gravitational pull, and at some point the market will always come back and test those averages. It's like, we could have said something similar back in mid last year, saying, look, the market's getting a bit stretched above these averages, and sure enough, made its way back and retested the averages. It's just how these things work. I think the play, just as it is in the ASX 200, just in the local market, I think it's keep holding stocks which are an uptrend, wide trailing stops, try and see off pullbacks. I think that's the best way of keeping upside open while managing risk. I'd be hesitant to be adding a whole lot of new risk to at an index level at this point from a risk reward perspective. I just don't think it's the best risk reward. I think that potential for a pullback towards those averages, getting a little bit too high for my liking. I'd prefer to look for opportunities in individual stocks, which are maybe doing their own thing. But overall, I'd be maintaining position. I think it's a market which is clearly in an upward phase.
Yep, very good. Do we want to have a quick look at the Russell 2000, the small caps?
Yeah, we can have a quick look at that. And I think this is a really interesting part of the market. Same goes for the small ordinaries as well. We've had this big sideways trading period, which has gone on for 18 months or thereabouts. And it's been interesting to see the Russell rebounding off this 50-day moving average each time it's come back and retested it. So it's a very different situation to what we saw throughout last year, where every time we got up to these resistance points, supply came in and it became a distribution event, and it was a lot of supply just kept pushing the market lower. We're seeing something different occur now. We're seeing we're seeing buy the dip. we're seeing accumulation on the pullback. So hence we're seeing this retest of the 50-day moving average, and the buying is coming in, it's pushing the market up. So quite different to what we saw at these 3 previous peaks, where it was supply coming on. Now it's demand coming in, and it's been underpinning this market. It's on the verge of a breakout from above this resistance area. It did have a peak above there in December. Wasn't able to sustain it at that point. It's come back, and that's not unusual, not surprising, because it had been such a strong run off the low. It's got to pause and got to consolidate. That's how markets typically work. It's just, for me, it's a case of where does it go from just here, where we are now? Is it going to come back and have another retest of these averages, or is it going to go from here? And I don't know. I don't have the answer, but my play would be stocks, which one is in, it's let them run, wide trailing stop. And if it does come back, retest, the wide trailing stop can help you stay in those stocks during the retest. And then if it then bases, maybe we get a big and sustained breakout then. So there's a few scenarios of how it could play out, but it's for me, it's one of the most prospective areas of the market as we head into this year.
Very good. And what about the Hong Kong market?
Yeah, it's really key point now in the Hang Seng. It's we've had this grinding rally over the last few weeks, and now back at that 50-day moving average, and the 50-day and the 100-day, they're still declining moving averages. So this is well, I've described this now as a danger level for the Hang Seng, and so is this period going to end up like these previous periods, which came back and retested the moving averages, and then after that retest declined again? You can see how that's played out several times over the last few months. So is that the case now, where we're retesting and we're setting up for another new low? That would, I'd say the odds do favour that, because path of least resistance at the moment remains to the downside, because we have an index which is below declining moving averages. So trying to say, look, maybe this is a low, it could be, but it hasn't been the case each time this has happened so far. So one day it will be, but the odds probably favour it will retest. This low from last week becomes a bit of a key point. So a break of that low would probably then open the door to a decline to a new low. But look, if it can stabilise here, track sideways, maybe it forms a base, maybe it does start to then creep above the moving averages. So it's an evolving situation. But at the moment, at this point, I wouldn't want to bet against the moving averages and start loading up on Hang Seng stocks at this point. I think it is a danger point, as I say, that this does get rejected from the moving averages and trades lower again.
Yeah, it's once again, it's just stalling and seeing, I think, what all the rest of the world is about to do. I think I like how Kirby's called. If we look at the S&P, he's called it a volatility contraction pattern, which has also happened on the Russell 2000, on the S&P, on the ASX 200, right? It's the price tends to coil and tighten before a breakout. I think you explained this quite a lot, Jason. So it's good. It's good how we can see that happening, right? So
yeah, it's just with this. It depends what time frame we're looking at. So we can say that this whole period here is a compression band of sorts, which at some point should break and lead to a strong move. Preferably to the upside, would we all be thinking? I think it would be to the upside, but of course, compression can release in either directions. Nothing's a sure thing. It looks like what we have at the moment could, like, for instance, I wouldn't be surprised if price action like this developed over several months, and then the market tried to break out. So what we have now, it's not really a compression at the moment. It's a bit overlapping, but it needs potentially more development, and maybe a compression band could form over several months. So again, I don't know whether that's going to happen, but it's one of the possibilities I have in mind when I talk about wide trailing stops. I want to be in the market in case it does run now, but in the event that it pulls back and does some work, a nice wide trailing stop could potentially see off a period like I've sketched in there. But it may not play out like that. Almost never plays out as you think it might play out. But yeah, it's some coiling action would bring some clarity to this chart and would be good, because we'll then give that back and filling that would consolidate that big run we've had off the October low.
Yeah. All right. Fantastic. Let's talk about our educational piece for today, right? And that is, once again, you've got them on the chart there. Supply and demand, or resistance and support. First of all, why does it happen, Jason? Why does it happen?
Well, we're talking a bit about it earlier, in where certain levels will become anchor points. So we've talked a bit about the ASX 200. Let's jump down. I'll bring up another chart. Let's call up a gold chart, and I'm going to put gold onto a weekly. It's an interesting one to look at, because there are a couple of really good examples within this chart. So let's start with this period from back here in around, where are we, 2016 to 2019, thereabouts. So gold had been in a large decline, formed a low point, went from below the averages to above, got to a new high at around for that period around 1350, and then start to do the back and filling underneath that level. So 1350 thereabouts became the level, became the anchor point. So it got there once, pulled back, retested it again. Supply came on around that level, pulled back, another test, supply came on again. So the more times a level is tested, the more it becomes ingrained in the across the market as being a key point. And the more times that it fails to get through, the more likely you are to find supply at that level waiting when it comes up and retests. But at some point, the supply can get exhausted, and the buying interest then overwhelms the supply, which ultimately happened in 2019. So we got a clean breakout through that level. And then the equilibrium has then changed, and the buying the demand has got to a point which now starts to push prices higher. So this is where we're understanding where the levels are. So firstly, you can identify them by looking at where previous activity has been. Can you line it up? And if you can line it up, then you have a resistance point or a support area if we're looking at it from the other side. So that was a nice clear-cut point. We got the break, and then that led to a strong upward period. Of course, upward periods have consolidations. It's not one-way traffic, but it was a lengthy period above rising moving averages. So that's where you can make good gains, when you understand the phase the market's in. You understand that the market's in a phase of rising above moving averages, which are also rising. That's a conducive environment for buying stocks. In this case, for buying gold stocks. Now it brings us to the present day, and we've got another anchor point, which is currently around 2080. So you can see the market's had three tests of that in over the last 3 years. Hasn't been able to get through. Brings us to where we currently are, which is a really interesting point. Let's go over to a daily chart, just see how it's playing out. And so last year in December, the market tried to, and this was interesting. This was during the Asian time zone, during our time zone, on a Monday morning, which is not a liquid time for gold. There was a brief push above this resistance point, would have set off a whole lot of stop losses, but then supply quickly came in a thin market, pushed it back down, and it's just been sitting below that resistance ever since. So this is a key point to watch in gold, because you can see how the supply is coming in around that level. Should we get another situation like we saw back in 2016 or 2019, I think it was, where we broke above that resistance point. That then opens a potential for a good move. So that's a really good example of like how resistance can cap a market. On a shorter term basis, you can also put in a trend line support. You can just see these lows here. I'm just going to link them up. They link up nicely, and you can see from a short term basis, gold has lost its footing somewhat, and so it's come out of this little compression band. You can actually draw some lines to the top side as well. You can see how gold has coiled up there within the last month and a half. Little coiling pattern below this major overhead resistance, and it's broken to the downside. So that would suggest there's some supply coming in now, again at this overhead resistance just beneath it. Market hasn't been able to get going above it. So maybe it's a case of people who have been accumulating positions on the maybe preempting an upward break. Maybe there's some unwinding of those positions currently happen. So you can from a short-term basis, maybe there's some vulnerability in gold where that supply is coming in. If there's a supply clean out, well then maybe that leads to a fall. So it can just help manage risk when you understand what you're looking for in those respects. But just showing what can happen when a market does break those key levels, just call up a uranium chart. And so this is, I've got an overhead resistance, which we've been looking at for months and months and months. You can see where the supply came on each time the market got up there, until at some point the supply was exhausted and there was enough buying expansion of demand to really propel it above that previous resistance. And we've had one of the best trends we've had in the commodity market for some time. But yeah, being aware, being able to identify the point through where we've got a series of high points where there's been technical activity. Doesn't always line up perfectly, as we had in 22. We had a brief move to the top side, but then that level has performed. It's really respected it well until we got the breakout point. That was the buying time.
Yeah, and just if you were more of a beginner like I am still, just to explain what supply actually is in the markets. Obviously, it's when it gets to these resistance points, and you've got all the people that have got that asset, and they're now they're trying to sell off their assets to the buyers, whoever's willing to buy at that point, right? That's why generally stalls a little bit up there as buyers are hesitant to buy at those levels, right? Until eventually, that supply gets let out to the market, right? Is that a good explanation of what's actually happening when we talk about supply, Jace? Or?
Yeah, pretty much. I'll show you a stock which is just watching at the moment, which is an interesting situation. It's LYC, which is Lynas Rare Earths. And so just looking at this chart, can you just for the viewers watching, can you see the key support level that is in play at the moment? And so I'm just seeing where it's come from. You can see we've had this declining market, and so what's just happened now, what you can do, you can see there's been this support area where each time Lynas has come down, there's been buying interest. So often in a declining market, buying interest can come in from people who see value. They think, look, this has fallen far enough. There's a value proposition here. It's a bargain. You'll hear people say, they'll say, oh, look, there's a great story here. You can't fall much further. And these support areas can form. And that's what we've had in Lynas, with this nice clear level across $6, thereabouts, around $6. Now, the problem I see for a stock where you see this sort of setup, so this isn't unique to Lynas, you see this set up across many stocks over time. So each time it's come back, there's been buying interest has continued to underpin it, kept pushing it higher. But each time it's pushed higher, supplies also come in, and you can almost draw a line. Actually, that works quite nicely along there. see this declining trend line. So each time the markets come up to around about the trajectory of this line, there's been supply coming in. Supply is coming a little bit lower each time, which is it's actually called a descending triangle. Is a technical name for this type of pattern where you've got a fixed support and a declining line. So supply, the sellers are more aggressive each time, and they add supply to the market. We're now at the point where it's broken below that support. So now you've got a case where these people who have been buying at 6 and 650 and all through here, these people who have been buying, they're now underwater. They're now losing money. So they've been buying on the hope that, okay, we've got a major low forming. So what do these people do now? So every time Linus has now been rallying back up to around this $6 region, supply is coming into the market. So potentially people who have bought, who are now losing money, they're getting out close to even every time it comes back to 6. So supply is coming into the market, which is capping its rally. And now if those who have been adding supply to the market all the way down continue to add supply, as well as people trying to get out, that creates a position where a market can fall quickly, or it can just keep grinding lower as there's just too much supply. There's not enough demand. So this is a dangerous situation, I think, to be holding stock, holding and hoping it forms a low, because you've got this supply issue potentially coming into the market. Now, should this quickly reverse and find itself back at 670 and above the moving averages, maybe you can build a case for a lows forming, but at the moment, the vulnerability is very much to the downside. And this is a risky time. If you're holding stock, what do? Do you hold it and hope that it's going to base somewhere, or do you cut positions? And this is what everyone's got to decide for themselves. What's their approach? What's their exit strategy when things go wrong? Because the worst case scenario is that in 6 months' time it's trading down at $2 or something, and from current levels down to $2, you're down 60% or something. It's like, well, that's not a good result, is it? So you've got to protect capital. Can't lose your capital. You can lose a bit. That's okay. That's part of the process. But you don't want wipeout scenarios where you're losing big chunks. And this is what, if we understand our levels, we know where things are breaking to the downside or breaking to the upside, we can play the odds. We want to be long stocks which are breaking to the upside, and we want to be getting out of stocks which are breaking to the downside.
Yeah. And obviously, to the opposite point which I made before, and you sort of demonstrated a great, even when supply is happening on the downside, on the way down, demand, obviously economics 101 here, we talk about demand happens when they might go down to those support levels and people are seeing them at those cheap prices, and all of a sudden there's all this demand for that stock, right? And so people are going in and buying that stock. Now the demand has to outweigh the supply for the price to go up, right? If the demand never outweighs the supply, then it will continue to go down eventually as the supply just wins. The guys who are wanting to sell off wins, right? So there has to be an imbalance in either side for the stock to move, right? So
Well, that's right. Well, there's the number of shares bought and the numbers of shares sold will always match, of course, but the one side is going to be more aggressive than the other. In this case of Linus, it's the sellers which are more eager to get rid of their shares than the buyers are to buy them. So the sellers are hitting the bids and pushing the price lower, and that's the definition of a downtrend. When the bids are getting hit and the bids keep getting lower and lower and they keep getting hit, you get a downtrend. The opposite applies in an uptrend where the offer's getting taken out and the buyers keep pushing up the price. But you'd say in a stock like Linus, the path of least resistance is down. So I want to build it, and this is what I do through Motion Trader. It's like Linus won't appear as a signal because it hasn't met the buying criteria for several years, not since it was in this upward phase. This phase, whilst it's been below declining moving averages, there's been no there's been no cause to buy. It doesn't meet the criteria of a stock which makes you money. At the moment, it meets the criteria of a stock which is going to cost you money. Now, every stock will ultimately bottom below its moving averages, but like, no, we don't know where that's going to be. So I'll forget about trying to pick the low, and I'll be building a portfolio of stocks which are above rising moving averages. So I'll be building a portfolio of stocks which meet this is a criteria I want to look for just in here, where the moving, it's gone from below the moving averages to above the moving averages across. This is a time I want to be owning stocks. These moving averages are like a dynamic support line. So whilst I've got price above the dynamic support, I'm happy to be long. When we get the opposite situation and we've got declining moving averages, as started to occur in 22, it's a time to close positions and step away and look elsewhere. So you want to build a strong stock bias in your portfolio, I think, not a portfolio of supposed bargains, because a lot of these supposed bargains get cheaper and cheaper.
Yeah. There was a saying that was told to me once, stocks that are on the way down, for me, and I always think about this, it's like trying to catch a falling knife, right? So I wouldn't want to do that, and that's what seems to happen with a lot of people that don't really understand these concepts, right? So
yeah, that's right. And people misinterpret buy the dip. They think buying Linus at the moment is buying the dip, but that's not the case. It's buying a downtrend. Buying the dip is when you're buying a stock which is coming back to rising moving averages. At least that's how I define it.
Yeah.
As you can see, this area I'm highlighting now, that's where I want to buy the dip, when it's coming back to rising moving averages, and this is where I want to just stand aside and look on and see what happens. But I'm not even looking on. I'm just calling up as an example. But this won't turn up on my radar until the structure changes radically to what it currently is.
Yep, exactly. All right, fantastic. Is there any other examples you wanted to provide around this, ideas and concepts, Jason? Or do you want to...
Let's have a quick look at ANZ. This is an interesting one because it brings in a couple of concepts. It's there's also a psychological factor around round numbers. People like round numbers. So if someone's going to buy a stock, they're probably more likely to type in, $1.10 than a $1.09, or sell something. They'll sell at $1.10 rather than a $1.09. It's just how we use round numbers. And this is interesting because 26 even became a bit of a thing for ANZ for a little bit over a year. So you can see this blue horizontal band. Doesn't all, it's round numbers is something you just be aware of. Doesn't work every time the market's going to stop at a round number. Sometimes there'll be something happening, other times there won't be. But you can see in this case, every time we got to 26, it was a supply point, and we had so many tests of 26, and only in the last month, well, even less than the last month, the last few weeks, ANZ's broken to the top side, and it's had that really nice upward run. So it's combined your classic horizontal resistance with a round number. And we're also talking last week or a couple of weeks ago about the S&P 500 5,000. And it's like, my point was, we looked at a chart that every time the S&P 500 has got to a big thousand number, so 1,000, 2,000, 3,000, 4,000, 5,000, it's paused for maybe several weeks, maybe a touch longer. There's been some volatility around that number. And my point being, watch 5,000 now, see whether we get that pause and volatility as we have at 1, 2, 3, and 4,000. And maybe that's where we do get that pullback to the moving averages. But look, it's psychological factors don't always play out, but they're good to be they're good to be aware of.
Yeah, obviously it's a sentimental thing as well, right? Whether people are looking at these levels and going, all right, well, everyone else is doing it, or something's, I'll do it as well, right? So yeah, it's a good point you bring up there, Jason. Very good. All right, well, let's if there's nothing else on that supply and resistance, Jace, did you want to move on to some questions from the
Yeah, I think that's a good idea. Let's do that.
Don't forget to like and subscribe, and send in any questions on the videos as well, or even to our support line. Just mention me or Jason. We'll be sure to get told these questions throughout the week and hopefully answer them in the next week. All right, so we've got. Let's have a look at a couple of. Let's have a look if we go through some questions. Let's have a look at just a couple of stocks first. Let's have a look at AD8 and AD8 to start off with. Scott.
88. This has been a good upward trend, this stock. And I know that because it's been in the motion trader portfolio for quite a while. And it's triggered a number of entry signals. So I think this would be an all-time high. Just put it on a weekly chart, and yeah, so all-time high. So the interesting things with all-time high is there's going to be no resistance because there's nobody who's owned the stock at this level before. So you don't have supply coming on from situations where someone has bought a stock, been underwater for a while, they're back to break even, so the supply comes on. You don't get that situation when a stock is at an all-time high. So people selling, they're essentially taking profit because they're in the money. With this stock here, it's very much upward trend is very much in place. This is a stock. If I owned it, I don't own this one, but if I did, it'd be a stock I'd be holding. I'd have my trailing stop loss, nice wide trailing stop, which can see off these bouts of volatility, these consolidations or pullbacks, and I'd be staying with it. It's always hard to buy a stock which has been rallying for so long. Look, for me, I'd struggle to buy stocks which have had such large runs. Having said that, I do know from years of experience and back testing that a stock like this can continue running a lot further. But for me, this is one to hold. It's not one I'd probably buy. I'm also looking at the steepness of the advance, and look, we had a steep advance during that August period as well, and that led to a consolidation back to the averages. Yeah, from a risk reward perspective, I'm probably not a buyer, but I'm definitely a holder.
Okay, fantastic. What about PME?
Pro Medicus, I think that would be. Yep, Pro Medicus. Yes. I don't know what the results or what the announcement was, but that has, and it's interesting, isn't it? Like there wasn't a hint of trouble. It closed at a I think that would be an all-time high. Yeah, it had closed at an all-time high, and then within 3 days we had this big downward move, and that can happen. That's just the stock market. There's risk, and things can change rapidly. Often the path of least resistance is where probability favours that the price is going to move, but there's no guarantee that you don't get these sudden reversals. And much of the time, I'd probably say most of the time, the bad stuff tends to happen below the moving averages. When prices are below the averages, that's when they're typically vulnerable to these large falls. But look, a stock that accelerates to the upside, it can have an abrupt return to the averages. If I had this, I'd still be in it. My trailing stops are wide enough to see off that type of pullback, because sometimes you can get these sharp moves, and then in a few months it's back at all-time highs. That does happen. It can happen. I'm not saying it will happen in this case, but sometimes this scary volatility does dissipate, and it stabilizes and moves higher again. That said, I'd have my stop loss in place. So we'll just call up. I'll put on a 10 ATR stop loss. So I use this on TradingView. They give an ATR stop loss calculator. This isn't the same stop loss that I use, but it's an approximation. It gives an idea. Now I just need to adjust it in the settings and put on the, I use a multiple of 10. So give it lots of room to move. And this is a really important concept, giving these stocks lots of room to move. Actually, this would be getting really close to triggering a 10 ATR stop loss. So there's not much in this now. This is, yeah, it's pretty close to where I'd be closing out. There might be a little bit in it, but not much. Once the stop loss is triggered, it's a case of step aside, protect capital, lock in hopefully a profit if you'd been in from lower levels when it was first triggering signals. So it's a take profit event, but if you're in at higher levels, then it's a case of taking some sort of a loss, hopefully a relatively small loss, and looking for other opportunities. But certainly not buying the dip at this point.
That point, yeah. Oh, no, I was just looking at the reason why it's gone down so much. It just looks like the what was expected from earnings and revenue didn't get met, so it was quite far off. So I don't know, or whether it was even that $110 psychological level you mentioned before, Jason. It's not far off, and it's just all of a sudden just dropped, right? So, but anyway, let's have a look at what about APX themes. APX long-term downtrend looks to have come to an end. New CEO cutting costs and further sold off heavily after losing Google account.
Appen. Yeah, it's this is a terrific example of why you have exit strategies. It's let's just look at the current price action. Look, for me, it's a no, because what makes this period we have now, what makes this different to this period we had during late 23? There's, they look quite similar, really, when you look at them. There's no distinguishing feature at this point. So for all we know, yeah, we've had a little bit of a bounce, like we had a bounce in December a couple of months ago, but then this could then emerge into lower levels again, sort of like running out of runway to the downside at 39 cents. But who's to say what it's going to do? And people will do that. They say, look, it's fallen so far, it has to stop here, but it could go out the back door. Again, that's not a prediction. I don't know. I know nothing about the fundamentals of the company, but that happens as well. Stocks do get delisted. So you've always got to be wary of that. It's not a case of, well, it's fallen so far now, so I can just pile in. So yeah, look, below declining moving averages, I think it's a high risk situation, but it's also a situation of like how a boom stock can become a bust stock. So like, just look at this, and this is what I was talking about before in regards to Linus, in that there were periods to own this stock. It had many years of being a boom stock, trading above rising moving averages, having periods of consolidation and big pullbacks as well at times, which would stop you out of positions, but then re-engaging the upward trend, staying above rising moving averages. So for a long time, this was a stock to consider having in portfolios. But once we had this big turn below the rising or declining moving averages, once the moving averages turned low and started declining, it's like there's just nothing to do here. Just leave it. Have the exit strategies, you're out, and you just leave it. And if you're using the moving averages as your key guidance tool to deciding which stocks you look at and which stocks you don't, you haven't looked at Appen since 2020. It just hasn't turned up on your radar. So you've been able to remove out of the ASX's 2,000 odd stocks, use this as a screen, and you'll take out probably more than half the stocks in one fell swoop, and put in another entry sort of filter, and you probably get 2,000 stocks, maybe down to a couple of hundred, 300 sort of prospective candidates. That's a lot of removing a lot of stuff off your screen and really helping you narrow in. It's not about having to buy everything which then meets your criteria, but then cherry picking from a prospective group and dropping off all the rubbish, which is just doing this, destroying value. You don't want to be there. There's no money to be made trying to pick the low in these stocks. You might get lucky here and there, but much of the time you end up down 50% going, what do I do now? And like a lot of amateurs do, they'll say, well, now I'll double up. And the sad story continues. And it's why I think a lot of people just don't make money managing their own portfolios. It's, they get too many of these in their portfolios and don't get out.
Yeah, fair enough. And I think this is, I mean, like, once again, this is, we never really look at the story behind it. Like the guys have just said that what happened with PME is also due to a share buyback, right? So I didn't see that. So that's what can happen when it, and obviously Dean's point out with APX, a lot of positive news around the fundamentals. But once again, if the share isn't looking to meet your criteria of a trending share, then it's, trending on the up, then let's cut it out for now, because there's so much more opportunity out there, right? So, but look, at the end of the day, it's up to you, right? We're not recommending either way. It's just one view versus another.
Well, it comes down to, no matter how much you like a stock, if the stock is declining below falling moving averages, the market doesn't agree with you. At the end of the day, it's the market's right. You can't, no point jumping up and down, yelling at the market saying, no, you don't get it. The market will value the stock as it does. And maybe the market does, reassess it in time to come. And you're right. But you can lose a lot of money in the meantime. It can take a lot of time to be proven right. And then what if you're not? What if you've missed something and the market's actually right and you're now down 80%? You can't say, oh, okay, well, market, you were right, I'll get back out. I'll get out when I should have gotten out a year ago or 2 years ago. It's too late. You're down 80%. Market's not going to help you out there with a better exit point. So it's why you go, well, look, I can see the story. I think this works. I can see how this is going to work. The market doesn't agree with me, so maybe I've got to get out now, but I'll keep an eye on this. And once it stabilizes, and maybe once some upward momentum just starts to creep in, then maybe I go back and initiate a position. Otherwise, you run the risk. And that's always the question you've got to ask yourself. What if I'm wrong? Am I prepared to sit at minus 80% or whatever nasty thing it may be? And if you do that in enough stocks, enough of the time, those losses will overwhelm your biggest winners. You've got to protect downside. It's the key to staying in this game and being able to prosper. You've got to protect downside and have a plan for it. It's Appen's not unique. There are plenty of charts you can pull up which look like that.
Of course. Let's have a look at CSL, please.
CSL. This has been in a good trend. Yeah, now we're just getting that pullback. Yeah, we're seeing a few charts like this around results. So it's interesting, isn't it? We're getting there's been a lot of exuberance in the last few months to buy, and now some results are coming out. We're getting pullbacks. So it's going to be interesting to see how they stabilize. So it's come back to the moving averages. So if it can stabilize around current levels, well, that potentially remains in play. It's been just compressing the chart, seeing where it's come from. Large sideways period, and we've had a strong rally off the low. So look, having a market back and fill and go sideways for several months after the recent gains wouldn't be unusual. If I had it, I'd still have it. It's interesting though. You go, well, would you buy the dip here? Potentially, this is where someone could buy the dip. You go, well, the risk reward does stack up, because I could have an exit stop. Maybe let's just measure that. Maybe I could risk 7, 8, 9%, and then if it does stabilize here and break up, I've got good upside potential, particularly if it starts to break out of this ranging period. So that's the sort of dip I'd consider buying. I think from a time perspective, it probably needs more time to chop back and forth. It's had that sharp decline recently. probably doesn't snap back tomorrow and start rallying. So I think there's probably some time there, but I think it's CSL's a stock with potential.
Yeah, very good. There, we'll just do one more, and it's GRR.
Range Resources. Right, so iron ore is this stock, and yeah, interesting. So is this a basing period? It's potentially there's a base forming here in that it's tried to rally above the moving averages a couple of times. It just keeps coming back. It's kind of going sideways and compressing now. So it's like, which way is this going to go? Moving averages are still to the downside, but it wouldn't take much for them to start turning higher from here. I'd probably be inclined to watch it. Mate, like you can come up with a trend line there, and it's like, I won't draw a trend line on the downside. There's look, a couple of ways. Like, would you want to pick the no, I wouldn't try and pick the low. Although if somebody were to do that, you could risk can be managed pretty simply with probably a fairly close stop loss. Maybe even just using this low from January. You could get into this with a close stop loss and punt a low. The low's in, and it's asymmetric because your upside is well north of what your downside is. The other play is just see what it does. Like, it could grind sideways for months or years, and a stock that comes down doesn't necessarily have to go straight back up. Some of these stocks will then just chop sideways and do nothing for ages, and some never come back up. So we don't know. So that's why you say, well, then, okay, well, buying into strength is my preferred play. You might say, look, if it got above the January high, then I'm buying into a bit of upward momentum. The moving averages are probably close to turning. It's probably above the moving averages. And then you can do some risk management. Say, okay, look, I'd buy it at, say, 44 cents, for example, and I could have a stop loss just back below the moving averages, maybe around 40 or something. And that would be asymmetric too, because you've got nice upside potential and you're managing risk. So yeah, look, it's an interesting stock. I could see why someone would be interested. Probably for me a little bit early, but certainly one where there could be something develops.
Yep, very good. I think we've done enough of the stocks for today because we're going to run pretty short of time. Jason, there's a couple of general questions here which we might answer. And I don't know how you do this one because it's very general. But Lee, are there any stocks that have been overlooked but performing quite well? And I think just having a service like Motion Control, having a system which can detect which stocks are going over the EMAs and breaking out, I think that's exactly what we're talking about all the time, right? It's not, you're not looking for the stories, you're looking for the trends, right? So
there are so many stocks which have been overlooked and are in good uptrends. And I just look at my portfolio. I think of two of the top liners: Dougtech, Duratech, Gentrack, MRM Offshore.
Step one. Did you hear of that one, Jace? Step one, the underwear company.
Yeah, it does something in retail. Who's heard of these stocks? Most people haven't. You ring up your broker. No, back in the days when you'd ring up your broker. Now, of course, we do everything online, don't we? And but back in the days, you'd ring up your broker and they'd go, "What are you talking about? What is Dougtech?" Most people wouldn't know because it's not an ASX 300 stock, and there's so many stocks. So your big household name stocks are in the ASX 50, and then good recognition of the ASX 100. Get to the tail end of the ASX 200, it's getting a little bit more, not everyone's heard of it, but your mainstream analysts will be across it. ASX 300, boy, you're starting to get into the outer bounds of the solar system, and then you go outside the ASX 300 or outside the All Ordinaries, and you're into interstellar space. No one knows what's out there, and this is where we're using screening techniques like using getting data and scanning, using moving averages, using breakouts. And those stocks I mentioned, they've all turned up in those scans. And I look at my own portfolio, and the vast majority I knew nothing about or had never heard of before they'd turned up in the scans. And but this is where some of the most exciting opportunities come from, because they are not widely recognised. They're not widely covered by brokers, if covered by brokers at all. And it's amazing what can be found. And look, there's the Standard and Poor's rebalance ASX 300 and 200 every quarter. There are always new names coming into the ASX 300. Always new names coming into the All Ordinaries. So how do you find these stocks before they come into the index? And they're coming into the index because they've been doing well. You find them by scanning. You find stocks and upward trends that most people aren't looking at, and you can get some terrific trends.
Yeah, fantastic.
So if people are interested, that's what I'm doing. So come over and check that out.
Yeah, I was about to mention that right at the end before this last question, obviously. But one more from Julian. I know Julian quite well. Is looking at the market depth a reliable indicator? By that, I mean, if there are far more orders on the buy side, would that indicate a higher demand than supply?
Possibly. It's yeah. Look, I think it's at the margin. It's probably a encouraging sign, but it's probably not. Wouldn't be my key driver of making a trade. There can be orders which are sitting, which are just off market. There are big players that have things they want to do, but they just they don't enter them into the system until and then they chip away at things slowly, and you don't see all the potential supply or demand when you look at market depth. It's just not showing, but it will be ready to come online. So it's an interesting factor, but probably not the most. You just can't be sure. You can never be sure what lies beneath.
Yeah, there's a lot of orders in the dark market sitting there which you can't see on regular market depth either, right? So yeah. All right. Look, I think there is one more stock. If you want to have did you want to have a quick look? Jason?
Yeah, of course.
AWC, and then we'll call it a day,
AWC, Alumina. Yeah, interesting. From below the moving averages.
Share your screen.
Right. Always helps when I share the screen. That looks better. So yeah, interesting stock. Below the moving averages to above moving averages are just starting to cross now. Yeah, this is the makings. It's the makings of an uptrend. Looking where it's come from. So yeah, it's been down and out. Like just because a stock has the characteristics of an uptrend doesn't mean that it's going to go into one, and doesn't mean that it's going to go into a big one. It could just fade out. So there were periods during 2020 and 2021 where Aluma started to look like it could have the makings of an uptrend. So we go back to this period. Or we can even just go back to this period here. Had you asked me then, I would have said, look, below the moving average to above, it's pulled back to the averages. Averages have turned higher. This is interesting, and it did get a little bit more interesting. Then it just faded out, and that's going to happen. So this is very much a numbers game where we're looking for stocks which have the characteristics of big trends. And then we're letting the good ones run. The ones that don't run, we cut them. We move on to other ones. But this would be one which I'd be considering. It hasn't turned up in the motion trader signals as yet. It will need to make a new 70-day high. So if we got a high above where we were in June, that would be a motion trader signal. But it meets the first criteria. It's above rising moving averages. We now need a breakout. And that goes into play, and then we see what it does.
Okay, fantastic. Thank you very much for today's session, Jason. Now, if you aren't a client already and you want to try Selfwealth for some very good fixed price brokerage and and great service, hopefully, then please try us out if you're not already a client. Jason, there's a few questions there asking about what software and stuff like that. I mean, that's exactly what your service does. So you can, clients who haven't tried it, they can always get a free trial using the links somewhere down the bottom on the video here. And of course, there is software that does it. Maybe we'll revisit that in another week, right? So because there's plenty of them, right? So, yeah. Look, thanks everyone for coming along. Much appreciated. I do love doing these sessions. They get me pumped each week to come here and talk and hopefully help our clients. And we've given some ideas to people. Obviously, past performance never equals the future sometimes. So please do your own research, and make your own decisions. But other than that, like and subscribe. And thank you very much, Jason, for another great show. Long one, but thank you very much.
Yeah, I've been terrific, Rog. Enjoyed doing it as always. And hopefully some good ideas for everyone to think about.
Exactly. All right. Thanks, guys. And we hope to see you again next week. Take care.